In this video, we will be looking at how we account for purchases and disposals of non-current assets. First, we'll start with the purchase of non-current assets, and we'll look at two options where we purchase with cash and purchase with loan. Firstly, we need to work out the cost of non-current assets, which are basically the costs that are incurred to bring the asset into location and condition ready for use. So in this example here, we've purchased furniture and we've also incurred delivery cost and assembly cost. Because the delivery cost and assembly costs have been incurred to bring the furniture into location and condition so that the asset is ready for use, we need to add all of these costs up to give us the total cost of non-current asset of $2,410. So in this next example, we've purchased computer and we've also paid for setup cost and IT maintenance for the first year. However, in this case, the cost of non-current asset would only be the cost of the computer and the setup cost, giving us an amount of $1,950. The reason why we do not include IT maintenance for the first year as part of the cost of non-current asset is because it is a benefit that's consumed and incurred within a year, and it does not add to the life of the asset. So using our example of our purchase of computer, this is how we record the transaction in the general journal. Take note here how we have taken up the total cost of non-current asset totaling to $1,950, and this was the combination of the computer cost and the setup costs. In a separate line, we record the prepaid IT maintenance of $600, and this is recorded on the debit side because it is a current asset where we expect to receive the economic benefits within the 12 months. In reporting the purchases of non-current assets, the two reports that are affected are the cash flow statement and balance sheet. Here we just need to make sure that we are classifying the items appropriately. Note that we can also take up a loan to purchase a non-current asset. In this example here, we've taken a loan of $3,000 to purchase a computer on the 1st of July. So before we take up the purchase of the computer, we simply need to take up the receipt of loan from the bank for the amount of $3,000. When we are reporting the purchase of non-current assets using a loan, we just need to make sure that in the cash flow statement, we are recording the loan from bank under the financing activities, and our balance sheet we are reporting the balance of the loan under the liability section accordingly. Now let's look into the disposal of non-current assets, and the first one that we'll be looking at is the cash sale of non-current assets. Here in this example, we have sold equipment for $1,100 cash. The equipment was purchased for $12,000 and the accumulated depreciation to date is $10,000. Therefore, as at 31st of January, which is the selling date, the carrying value of the equipment works out to be $2,000. So on one hand, we're selling equipment with a carrying value of $2,000 and we are receiving cash of only $1,100. So effectively, we are making a loss on the disposal, where the proceeds from disposal is less than the carrying value. Now we're going to record the cash sale of the non-current asset. Normally, we would start with the general journals before posting the entries into the general ledgers. In this case, I'm starting with the general ledgers because I would like us to have a look at the movements of the entries so that we have a better understanding of the transactions that we need to record in the general journals. The first thing that we need to do is to transfer the balance from the equipment account to a disposal of equipment account. And we do this by crediting the equipment account and debiting the disposal of equipment account. Next, we also need to transfer the balance from the accumulated depreciation account to the disposal of equipment account. So as it is in the disposal of equipment account, if we take the debit amount of $12,000 less the credit amount of $10,000, this would give us a debit amount of $2,000, which is essentially the carrying value of the equipment that we are selling. Next, we need to take up the proceeds of the sale of the non-current asset. Because it was a cash sale, we need to debit the bank by $1,100 and we credit the disposal of equipment account by $1,100. In this next step here, we need to close the disposal of equipment account because firstly, this was just a clearing account, and secondly, here we need to calculate the profit or loss that we've made from selling the equipment. From our earlier exercise, we would have worked out that we have made a loss of $900. And this loss needs to be transferred from the clearing account disposal of equipment to an expense account called loss on disposal of equipment. And because the loss on disposal of equipment is an expense account, this account is therefore close to the profit and loss summary. And this will then be reported in the income statement under expense. Now that we understand how the transactions are meant to look like in the general ledgers, we can use the general journal to take up these entries. So in this first entry, we can see that we are transferring the balances from the equipment and accumulated depreciation accounts both into the disposal of equipment account. In simple words, we are transferring the carrying value of the equipment into a clearing account called the disposal of equipment. In the next entry, we are taking up the proceeds from the disposal of equipment. And in this case, because it was a cash sale, the proceeds were therefore $1,100 cash, which is a debit to the bank account and a credit to a disposal of equipment account. Now, once we've worked out that we've got a loss on the sale of the equipment, we are transferring that loss from the clearing account called disposal of equipment to an account called loss on disposal of equipment. And this loss on disposal of equipment account is an expense which is then reported in the income statement. Sometimes we can also make a profit on disposal of a non-current asset. This is a situation where the proceeds from the disposal works out to be more than the carrying value, such as this example here given. Even if the cash sale of non-current assets result in a profit, the steps in recording the entries would be the same. We still transfer the balances from the equipment account and the accumulated depreciation account to a clearing account called disposal of equipment. Then we take up the proceeds of the disposal, which works out to be $3,000 cash that is debited to the bank, and we credit the disposal of equipment account for $3,000. When we close our disposal of equipment account, we can see that we've made a profit on disposal of $1,000. This amount is then transferred to another account called profit on disposal of equipment, which is essentially a revenue account that would be reported in the income statement. This is how it looks like in the general journal. So the first step is where we transferred the carrying value of the equipment to the clearing account called disposal of equipment. The next step, we record the proceeds from disposal of the equipment. And in the final step, we work out the profit on disposal of equipment, which is a revenue account that is then reported in the income statement. Sometimes, instead of receiving cash for a disposal of non-current asset, we could also trade in our old equipment for a new equipment. So in this example, we are purchasing a new van worth $30,000 plus GST. But the main thing that we need to firstly work out is how we are disposing our old van. In this case, we are trading in our old van for $700. And our old van had a cost of $26,000 and an accumulated depreciation of $24,800. Therefore, at the date that it was disposed, the old van had a carrying value of $1,200. So here we are trading in our old van with a carrying value of $1,200. The salesman at the shop reckons that the trade-in value of our van is only $700. In this case, because the trade-in value is less than the carrying value of the van, we have made a loss on disposal. The salesman also says, your old van only pays $700 of the new van. You still have to pay for the balance of the new van, $32,300. Recording a trade-in of a non-current asset is different to recording a cash sale of a non-current asset. The first entry is still the same, where we are transferring the carrying value of the van from the asset account and the accumulated depreciation account to a clearing account called the disposal of van. Our second entry is different. Instead of taking up the cash proceeds, here we are taking up the trading value of the van. We do this by debiting the van account by $700 and we credit the disposal of van account by $700. If you think about it, it's logical to record the entry this way because the $700 trading value contributes to the cost of the new van, and this is why we are debiting the van account for the amount of $700. Our next entry is the same as what we would have done if it was a cash sale. We are transferring the loss on disposal of the van. In this case, it was $500. We are transferring the loss to an expense account called loss on disposal of van. Our final entry is an additional entry compared to if we are selling a non-current asset for cash. Here we need to take up the balance of the new van paid in cash. Now what you will see here, because previously we've already allocated $700 from the trading value to the cost of the new van, therefore in our van account we only need to take up the balance of $29,300 to make up the total value of $30,000, which is the cost of the new van. In our bank account, we can see that because the $700 trading value has already contributed to the cost of the new van, the balance of the amount that we need to pay is only $32,300. The GST clearing account would still be the 10% on the entire $30,000 cost because we have not recorded the GST entry earlier. Whether it was a cash sale or trade-in of non-current assets, we report for the disposal in the income statement. If there was a profit on disposal, we report it under other revenue. Or if there was a loss on disposal, we report it under other expenses. Thank you for watching.